If you're an Edexcel A-Level Business student looking for a video to revise all of Theme 2.3 Managing Finance, well, this video is for you. Because we're going to cover everything that you need to know for your exams, including going over our income statement, talking about what profit and profitability is. We'll also take a look at some key distinctions between profit and cash. Then we'll take a look at what a balance sheet is and all the key components. Then we're going to get into some important liquidity calculations such as the current ratio and the acid test ratio. And then we'll finish this session up looking at what working capital is and the different causes for business failure. Let's get into it. Now, the very first topic that we want to look at in this revision session is taking a look at what an income statement is. Now, an income statement is also known as a profit and loss statement. And essentially, it's within the name. It goes over the company's profit and loss for a specific time period. And on the screen here, you can see an example of what that income statement would look like with three different types of profit. We've got our gross profit, operating profit, and net profit. Net profit can also be called profit for the year. But always remember the acronym GON, G-O-N, because that's the order the profit comes up within the income statement. Now, just to go through some of these different lines and what they are, revenue, we've already covered this before, is just the amount of money a business will make from selling products and services. The way we calculate this is we take the selling price times by our units sold. Then we've got this concept called cost of sales, or also known as cost of goods sold. And these are the direct costs involved with making a product or service. So this could be some examples such as the raw materials used to make the product. It could be the packaging materials. It could also include direct labor. So that's employees who are directly involved with making the product or service. It is also very similar to the concept of variable costs. Then we've got what we call our operating expenses. Now, if cost of sales is the direct expenses involved with making the product or service, your operating expenses are the indirect expenses. So they're not directly involved with making the product or service, but they will cover our company's day-to-day operations. So, for example, the salaries and wages of the rest of your staff, maybe who work in HR and marketing. We could also look at the rent for the buildings and the facilities that we use, any research and development costs, and also our utility bills. And it's key to note your operating expenses, once again, fairly similar to the concept of your fixed costs. And then we've got our finance costs. Now, these are the expenses incurred by a business for borrowing money. So, for example, if we was to get a bank loan, we would normally have to pay interest on top, and that interest would go into our finance costs. Now, you can also actually have interest earned, so potential savings, and this would be deducted from this cost. And finally, we have our taxation. So this could be around corporation tax or income tax. And this is basically the tax that you would pay on your profits. So for a company, at the moment, corporation tax is around 25% in the UK. Now, on to our important calculations. Now, once again, always remember the acronym GON, G-O-N, because that's the order the profit comes up within your income statement. With G, it is our gross profit. And the way we calculate this is that we take our revenue minus those costs of sales, those direct costs involved in making the product. So in 2023, we made £10 million of revenue and our cost of sales was £6 million. Therefore, our gross profit is only £4 million. Then we move on to the next stage. We look at our operating profit. The way we calculate this is that we take our gross profit minus our operating expenses. So once again, in 2023, we said gross profit is £4 million. Our operating expenses are £2 million. Therefore, our operating profit would only be £2 million. Then we have our net profit, but this is before tax. So we're only going to deduct our finance costs. So as we said before, operating profit is £2 million minus your finance cost of £500,000. So in 2023, our net profit before tax is 1.5 million. And the last stage, the net profit after tax. So all we do is we take our net profit before tax and then minus the tax that we have to pay that year. Now, with the tax that we pay that year, let's just say it's our corporation tax of 25%. So if our net profit before tax is 1.5 million, 25% of that is obviously £375,000, which would leave the business net profit after tax of £1,125,000. And that profit is what the business can pay their dividends to the shareholders, or they can decide to reinvest that back into the business, called retained profit. The next topic we're going to be looking at in this revision video, which is quite a nice one to follow up after we've just looked at our income statement, we'll be looking at our profitability and our profit margins. Now, when I think about profitability, I think about efficiency. How efficient is a business as taking something and turning that into profit? So typically that something could include the revenue. So how efficient is the business taking their revenue and turning that into profit? Or it could be around their operations, or it could be around the capital employed of the business. So profitability, all it means is the ability of a business to make a profit from either their revenue, costs, or their investments. And one of the main ways of measuring a business's profitability is by looking at our profit margins. Now, it is possible for a company to be making more profit from the previous year, but making a lower profit margin. And whenever we want to try and calculate our profit margin, you want to divide that specific profit by the revenue we've made. So looking at our income statement, remember the three types of profit we have: gross profit, operating profit, and net profit. So of course, to look at the profit margin, as we said before, we just take the profit divided by the revenue and times by 100. But when we look at the specific type of profit margin, let's say gross profit margin, for example, we just take the gross profit, divide that by the revenue and times by 100. Now, this obviously depends on the specific industry that you're in, but the higher the better. So anywhere between 40 to 70% is a really good gross profit margin to have. Next up, we have the operating profit margin. Once again, same principle. Take the operating profit, divide that by the revenue and times by 100. Now, once again, depending on the industry, operating profit anywhere between 10 to 20% is really good. And finally, you also have your net profit. Now, our net profit margin is calculated by taking the net profit divided by the revenue and times by 100. Now, of course, the higher the profit margin, the better, as it indicates the business is more effectively controlling our costs and generating a higher proportion of profit from its revenue. Now, a business's profit margin, as we said, will depend on the industry it operates in, because different industries have varying cost structures, different pricing strategies, and different competitive dynamics. So, of course, you wouldn't want to compare your profit margin with a different industry. Instead, you'd want to compare your profit margin internally, so looking at previous years, or you would want to look at your competitors. The next topic we're going to look at in this revision video is one that actually students typically struggle with, which is identifying what is the difference between profit and cash. Now, there are 4 different examples I have for you. And the first example that we'll use is a revenue on credit. Now, let's say in my business, I'm producing TVs and I sell each TV to a customer for £1,000. But what I might do is I might offer them some credit terms. So the customer would get the TV today for £1,000, but they would only pay £200 cash because the rest of the £800 would come out, after 60 days. Now, when we look at how we start recording this, and this is the key difference between revenue and cash. Well, today we have to record the £1,000 transaction. So I would have to record for my revenue £1,000. But I can only record the amount of cash I've received. And the only amount of cash I received is £200. And when we look at trade receivables, which is just the amount of money my customers owe me for products they brought on credit, of course, that's going to be £800. So the key difference here is that you have to record your revenue in full amount of the actual transaction of the product. But in cash-wise, you can only record the amount that you received. So you could have a really high revenue, a really high profit, but you could have cash flow problems. The second example we have is our delayed payment expenses. So this time, instead of me selling my product, I'm looking at buying raw materials. So let's say I've got these raw materials that I'm purchasing from my supplier worth £100,000. Now, I want to buy these on credit. So I'm going to say to my supplier, how about I give you £25,000 worth of cash today, and I'll give you the rest of the money in 60 days time. Reason why: I want the raw materials, use that to make my products, use that to make sales, make some cash, and obviously pay that to my suppliers. But we ask the question, well, how is this now going to impact my cost versus cash? Well, when we look at the cost of sales I have to record everything. I received £100,000 worth of raw materials, so that's what my costs are going to record. But in terms of cash, we only measure how much is flown in or out of the business. And on that specific day, we've only recorded negative £25,000. Now, when we look at the concept of trade payables, this is the amount of money I owe to my suppliers for raw materials brought on credit. And we typically call this situation, we owe money to our creditors. Now, the next example we have is loans and repayment. Now, loans, remember, are a really important source of finance. So let's say I go to the bank, I've asked for a £10 million loan, and they've agreed to it, and they've said, right, we're going to charge you a 6% interest rate. Remember, interest rates are the cost of borrowing or the reward for saving. So I've received £10 million from the loan and I have to pay them £10,600,000 back. That's a 6% on top. Now, in terms of my revenue, my cost, the cash in and cash out. Well, first of all, revenue, I've made none. Then remember, with revenue, you only make this through selling products or services. In terms of the cost, well, it's the cost of borrowing. It's the interest rate that's been charged for the loan. Well, that would be £600,000. But now in terms of the cash in versus cash out, well, we've received £10 million today of cash in. And in terms of the cash out, well, we won't record 10.6 million straight away. That would be more so over the long term. And the final example that we have about the difference between profit and cash is this concept called depreciation. Now, let's say I'm purchasing a van and I've paid for it all up front. Okay, that's the assumption. So we've paid £10,000. Now, if that is the case, we want to look at, well, what is my expense for it and what is the cash outflow? And what we are doing, we are assuming that the van has a lifetime expectancy of 5 years. And after those 5 years, it will be worth nothing. So it's going to lose value over time. Well, in terms of how we would expense this as a business, we would separate that £10,000, divide it by 5, and that's how it would show up as a cost in our income statement. So each year it's going to cost me £2,000. But when we look at the cash outflow, remember that assumption from earlier, we've paid that £10,000 up front. So in year 1, the cost would be £2,000, but the cash outflow would be £10,000. And then year 2, 3, 4 and 5, the expense would be £2,000 for each year, but the cash outflow would be 0 because all the money has already gone out the business. And the next topic we're going to look at in this revision video, which is one that students don't like very much, is our balance sheet. So we already looked at one of the key financial statements at the start of this video with our income statement, also known as profit and loss. Now we are going to look at a balance sheet. Now this might look very scary. Don't let it overwhelm you. We're going to break each of these down. But essentially, a balance sheet is a financial statement that shows a business's assets, liabilities, and equity at a specific point in time. It provides a snapshot of its financial position. Now, bear in mind, balance sheets are also known as your statements of financial position. And as we said, they cover assets, liabilities, and equity. Assets are the things that you own. Liabilities are the things that you owe. And equity has a couple of different definitions, but more on that in just a moment. Now, the reason why it's called a balance sheet is because it should balance. Our assets should equal our liabilities plus equity. Because when you look back here, you can see that the business's total assets are equal to £500,000, total liabilities £200,000, total equity £300,000. And of course, when you add those together, your total liabilities and equity equals £500,000. The exact same as your total assets. And another formula that you need to know is our net assets. And that's just equal to your total assets minus your total liabilities, which is also equal to equity. Keep that in mind for later on. And when we look at our assets versus liabilities, these can be broken down even further into current and non-current. An easy way to remember the difference between these two: current is within 12 months, non-current is after 12 months. Keep that in mind. Now, as we said, what are assets? Assets are items that the business owns. So when we look at current assets, well, we know the term current is within 12 months, but what do we want to do with them in the next 12 months? And essentially all we want to do with our current assets is that we want to use them or convert them into cash within the next 12 months. Now, looking here, we've got a few different examples. First of all, we've got cash and cash equivalents. This is just any liquid cash the business has, maybe cash in hand or money in the bank. Then we've got our inventory, which covers 3 different things. Covers our raw materials, our work in progress goods, and our stock, which is ready to be sold to your customers. And then we've got this concept called trade receivables, which we did have a look at it just earlier on in this video. Now, a trade receivable is the amount of money your customers owe you for products or services they bought on credit. Now, in this instance, we call those customers debtors. So it's the amount of money these debtors owe you because they've brought something on credit, but they've not yet paid for it. And then we've finally got something called prepaid expenses. Essentially, you've paid for a cost in advance, but you've not experienced it yet. So for example, I've paid ahead of my rent, but we've not experienced the rent for that month. Next up we have is our non-current assets. Now remember, non-current is after 12 months. So if assets are items that the business own, well, all non-current assets is that the business owns this asset, which it wants to keep for longer than 12 months. And the reason why is because this asset can generate us some economic benefit, i.e. we can use it to help either make products or service or deliver them to customers. We've got a few more examples as well. Now, non-current assets can also be called as fixed assets, just mean the exact same thing, and they can either be tangible or intangible. Now, tangible, just things that you can touch, whereas intangible, they have no physical presence. You can't touch them. Now, in terms of the different examples, we've got property, plant and equipment. These are just your tangible long-term assets such as buildings, machinery, vehicles that the business uses. We've also got this concept called goodwill. Now, goodwill is not a lad called Will who's done really good in his business exams. Goodwill is basically when a business buys another business and pays more than the value of its net assets to reflect these intangible benefits like the business's reputation or the customer loyalty it has. Then we've got any other investment. So any other investment could be shares that the business owns in another company. And then we have our liabilities. Now remember, assets are the items the business owns. Liabilities is the debt the business owes. And remember when we talked about current, within 12 months. So all current liabilities is any debt that the business is due to pay within the next 12 months, within the next year. So some examples could be trade payables. Now essentially these are the opposite of trade receivables, because trade receivables is the money that the business is waiting to receive from their debtors, whereas trade payables is the money the business owes to its creditors for items they've brought on credit. So for example, I brought in raw materials, but I've just not paid the full amount to my suppliers yet. And then we've got our bank overdrafts. Now these are just your short-term borrowing facilities. Essentially, it allows you to spend more money than you actually have in your bank account. And the reason why we want to pay these in the next 12 months is because the interest rates are very high. Then we've got any other short-term debt, so anything else that we just need to owe within the next 12 months. And then finally, we've got something called accrued expenses. Now think if prepaid expenses is a cost that we've paid for in advance, so an accrued expense being a current liability, something we owe within the next 12 months, essentially we've experienced the cost, but we've just not paid for it yet. So for example, I've experienced the rent this month, but I'm behind on payments. And then we have our non-current liabilities. Remember, liabilities is any debt that the business owes, non-current after 12 months. So put those two together, all non-current liabilities is any debt the business owes, which is not due until after 12 months. Now this can also be called your long-term debts or your long-term liabilities, all mean the same thing. Now you can have quite a few, but in this example here, we've just got a loan, which is a long-term borrowing facility. But other typical non-current liabilities could be pensions, could be long-term leases, could be deferred tax liabilities, and so on. And then we've got equity. Now, equity is a little bit different to your assets and liabilities. But, go back to the start of this section. We said that the formula for the balance sheet, the reason it's called a balance sheet is because it balances your assets are equal to your liabilities plus equity. So if I was to rearrange that equation around, I've got equities equal to your assets minus your liabilities. So when we look at defining what equity is, it's the owner's claim on the business's assets after all liabilities have been paid. And another way of looking at that is what the owners are investing into the company. And we've only got 2 types of equity on our balance sheet typically. First of all, we've got something called share capital. Now this might sound familiar from our sources of finance. Now all share capital is when the business sells shares to investors and of course they purchase it. The money that they invest into the business, buying the shares, That is called share capital. And we have retained earnings, also known as retained profit. So after the business has paid off all of their taxes and their costs and their expenses, they have a net profit after tax. Now that profit could be paid as dividends to your shareholders, or the business might reinvest that back into the business, and that is what we call retained earnings. Just a quick one, if you need a bit more support with your exam technique, such as how you improve your analysis, how to apply more within your answers, and how to evaluate more, well, I've created a free exam technique course that helps you with this. It also goes through the key answer structures that you need to follow for your exams, including those 4 markers, 8 markers, 10, 12, and those dreaded 20 markers. You can access this exam technique course for completely free using the link in the description. Back to the video. The next topic we've got in this revision video, we'll be looking at liquidity ratios. Now we've got 2. We've got the current ratio and the acid test ratio. Typically, students do not like these 2 ratios. However, now we've done our balance sheet and what all the different components are, these ratios become a lot easier to understand. Now, starting off with the current ratio, you might think, oh, I've just learnt about current assets and current liabilities. Well, all we are doing within the current ratio is dividing one by the other. Really easy way to remember this formula. So current assets, anything that the business owns and intends to turn into cash within the next 12 months, but divided by current liabilities, any debt the business has to pay in the next 12 months. So logically, we're thinking, well, we want the business to have more current assets and current liabilities, because it shows that the business has the ability to turn stuff into cash and pay their debts off within the next 12 months. An example could be like this. Typically, your examiners are mean and they won't tell you that the current assets are equal to this and the current liabilities are equal to this. They'll give you a list of all the different items on the balance sheet. That's why we need to understand what a balance sheet is first. But looking at this balance sheet here, we've got inventory of £50,000, cash and cash equivalents of £25,000, trade receivables of 15 grand, trade payables of 60,000, and an overdraft of £15,000. Now, this first step that we need to do to calculate this is to organise it. Which one are current assets, which one are current liabilities? Now, we can see the top 3 are current assets and the bottom 2 are current liabilities. All we have to do, add them all together, put them into the formula, and then we've got our current ratio. So we do this, we get a current ratio of 1.2 to 1. Now, what that means is that for every £1 of current liabilities the business has, we have £1.20 of current assets. Essentially, we want more current assets than current liabilities. But the question that we ask now, well, what is a good current ratio to have? Logically, well, surely we want more current assets than current liabilities. But how much more? The ideal ratio is anywhere between 1.5 and 2. Now, if it's below 1.5, a business may struggle to pay its short-term debts, leading to cash flow issues and reduced confidence from their investors. But if it is too high, so if it is a current ratio of 16 to 1, 50 to 1, there's a couple of different reasons why this could be a bad thing. Well, first of all, the business could be holding on to too much current assets compared to their current liabilities. Maybe suggesting poor inventory management. Maybe suggesting that we've got lots of cash but we're not investing into it. Or it could just mean the business is a little bit cheaper to buy. Because if we've got lots of cash in the business and another company takes us over, well, they obviously acquire the cash that we had as well. But now we've got this second formula called the acid test ratio, and it is very, very similar to the current ratio. There is only one minor difference. Because looking at the current ratio, well, it indicates, do we have the ability to pay off those short-term debts with our current assets? Now, the issue with the current ratio is that we also include the inventory. Now, the problem with our inventory, we don't know if we're going to sell it all. We don't know if we're going to sell any of it actually. And when we are looking to pay off those short-term debts, well, the people who we are paying those debts to, they don't want just unsold inventory, they want cash. And it can be quite difficult for a business to get their inventory and convert that into cash. And this is what the acid test ratio wants to tell us. It wants to say, well, what if we didn't sell the inventory? What if we took our inventory, our stock away from our current assets? Do we still have the ability to pay off those short-term debts? So we do the formula of current assets minus your inventory, also known as stock, divided by your current liabilities. So going back to that example we just looked at, we know the top 3 are current assets, we know the bottom 2 are current liabilities. but this time we're taking away that inventory from that current assets total. Another way that you could do it is just adding the cash and cash equivalents with the trade receivable, so not adding the inventory in the first place. But what this acid test ratio now tells me is that I've got 0.53 to 1. And what that basically means, for every £1 of current liabilities, short-term debt that needs to be paid off in the next 12 months, I have 53 pence of liquid assets. What a liquid asset is just items which are easily turned into cash. Inventory, not so easy. So what a business should aim for is an acid test ratio above 1. And this is where your evaluation has to come to. Because if we don't have a really good acid test ratio, then we may struggle to cover those short-term debts. Of course, it depends on how easy is it for us to sell our inventory. And the last thing that we want to look at now is, well, how do we improve our liquidity? Because if we did have a poor liquidity position, how can we go about improving it? Well, first of all, let's say we have a poor liquidity position in terms of the acid test ratio. So we might be holding on to too much inventory. But we could implement our just-in-time management. So only receiving that inventory as we need it, as the orders are coming in. We could also look at managing our receivable and payable days. So receiving cash from our customers quicker than we're paying off our suppliers. We could then obviously cut any unnecessary expenses, maybe selling off unnecessary assets, of course bringing in a lot of cash. And of course that would reduce as well our current liabilities. Look at sourcing any additional funding, so maybe look at a bank loan because that would be a non-current liability, not a current liability. But of course the evaluation is, well, that non-current liability will eventually become a current liability. So you have to plan for the long term. And just finding ways to increase your revenue. Because of course, if you are selling more of that inventory, turning that into cash, well, that liquidity position begins to improve. The next topic we've got in this revision video, which is only a short topic, is looking at what this concept of working capital is. The amount of times I've marked my students' work and they say, well, it will improve the business's working capital. And I ask them, well, what does that mean? They don't know. Now, working capital is fairly similar to the current ratio in terms of how we calculate it. Now, when we look at working capital, it is the money available for a business to cover its day-to-day expenses. So it's those short-term expenses that we have. Now, the way we calculate it is that we take our current assets, we don't divide this time, we minus the current liabilities. Now, you don't want to have an extremely high working capital, as this means we're potentially not utilising our current assets. Potentially, we've just got lots and lots of cash lying about and we're not investing it into strategic decisions. But of course, if our working capital is too low, even potentially negative, all it means is that you don't have enough working capital to pay off those day-to-day expenses. And the very last topic within this revision video that we're going to be taking a look at is business failure. Now, there are two main categories. We've got internal methods of failure and we've got external. Let's start off with our internal methods of failure. Now, along with a lot of the concepts we've spoken about today, looking at finance. The biggest reason why businesses fail and they don't survive is because they have poor cash flow management. We spoke about the differences between profit and cash earlier on. A business could be highly profitable but have poor cash flow management. But the problem is we may be giving those debtors too long of a credit period where they don't pay us until 3 to 4 months' time. We still need to pay our creditors off within maybe a month or two. So poor cash flow management is one of the biggest reasons why businesses fail. There could also be a lack of planning, so whether that's strategic, whether that's forecasting. I might expect that the business's growth in sales is really good, but turns out it's really bad, and I brought in all of this excess amount of inventory which ends up going to waste, or vice versa. We don't plan that we're actually going to do really well, and then all of a sudden we have loads of demands there we can't actually meet. And that could cause the business to grow at an uncomfortable rate where we don't have the systems and the operational processes in place. Another massive one is around the leadership, the culture and the decision making. And when I think about this, is the business responding to the change in the external environment? A great example is when Blockbuster didn't really care too much about their new rival of Netflix. Because they thought, well, everyone's going to buy these CDs and DVDs. But then Netflix offered a new unique offering of streaming services. But the leadership, the culture within Blockbuster was, well, we like to do it this way. This is how people have always done it. And that inability to respond to change comes from those internal failures. Failure as well to innovate, meet customer needs. Imagine if Apple just didn't innovate anymore and we were still stuck on the iPhone 8. I can guarantee they would not be making anywhere near as much sales as they are today. And of course, if they aren't controlling their costs. So when we looked at profitability earlier on, at our profit margins, well, imagine it's really low. Imagine their gross profit is 20%. Their operating profit is 1%. So potentially for the business to make £100,000 of profit, we need to make over £10 million of revenue. That's really inefficient and is not sustainable over the long term. Then we've got our external methods of failure. Of course, we've got changes in the economic conditions. So potentially if we saw recessions, meaning that on average unemployment begins to increase. So if unemployment rates are increasing, then less people are earning money. And if less people are earning money, less people are spending money. So the demand for my type of products may decrease. That depends on the income elasticity of demand. Inflation as well is another topic. So for example, if our costs all of a sudden increase, then once again, people's disposable income might start to go down. My prices would have to increase. Law of demand, prices go up, demand goes down. And then all of a sudden, no one wants to buy my products because they've got less income and our prices are too high for them. We can also look at the changing environment, in the fashion industry. Consumer trends and wants and needs and preferences change every single day. A new influencer might be wearing a different type of style, then all of a sudden every fashion retailer has to start accommodating for that. If you don't, once again, how well do you adapt to that change? Level of competitive rivalry, there's a great model that we'll be learning in Theme 3 called Porter's 5 Forces. Now, if the intensity of the competitive rivalry is too high, we find price wars, we find ways that our larger competitors are innovating so much into differentiation that we can't keep up. And the market may just be too saturated. There may be too many businesses entering that market and not enough customers to go around. We can look at the cost of materials increasing, kind of relating to inflation. So overall, our profitability would reduce. And finally, changes in government legislation. Now, if we was a cigarette company, well, UK smoking laws have changed recently to make sure that none of the new generations can legally buy cigarettes. So essentially, my entire business has now failed because of a change in legislation. Now, if you want to carry on your revision of Theme 2 topics, I highly recommend you check out our video here on Theme 2.4 Resource Management. Because in that video, we're going to go through some key concepts such as the different methods of production, what capacity utilization is, our different methods of lean production, including just-in-time and Kaizen, and much more. Thank you so much for watching this video. I hope this helped you out with your revision, and I'll see you in the next one.